The market has priced more than 100% chance of a Fed rate cut on July 31st. I've never seen that in 25 years, more than a month out. Can you ignore that? Can you ignore what the market is telling you?
Well, the markets are trying to figure out, they're trying to think about what the reaction function of the Fed is. And I think on the heels of the press conference, we had a pretty good indication, and I agree with that indication, that we had 6 weeks of data that looked quite a bit different than May. We had some softer readings on inflation, one softer jobs report, and a lot of headwinds blowing our way, financial conditions, global growth, and considerable uncertainty around trade. So being in a look for the next 6 weeks of data and seeing if that 6 weeks was transitory or if it really sticks is where I am. And I think that the markets are trying to figure out that as well.
Well, the markets seem to have decided. Are they bullying the Fed into a rate cut?
I don't perceive it that way. I mean, when I do my job, I'm just thinking about what we talked about thinking about, which is we had data that 6 weeks that gave us a little bit of pause, and we're looking and seeing if those data persist and if they're going to slow the economy in a meaningful way so that we can achieve our dual mandates.
Well, Chairman Powell said consumer spending holding up well. Business spending has fallen on uncertainty about trade policy for the most part. So how does monetary policy address that? Nobody seems to be complaining about the cost of capital.
Well, if you accommodate the economy, so we were thinking the economy this year would come into something close to a sustainable pace that would gradually lift up inflation and support ongoing strong job market. With the data as they're coming, it looks like some of that momentum, we still have the momentum of consumer spending, as the chair said, but now these headwinds are blowing against that momentum, and monetary policy being more accommodative would stimulate both consumers and also then businesses.
I mean, consumers are spending. Businesses don't want to spend, not because they need a cheaper loan.
Well, businesses do respond to the sense that the economy is going to be on a sustainable pace or it's going to falter. And that mood shift can be very much supported by the actions of monetary policy. But also, I'm not convinced that businesses don't respond to the cost of capital still. So they might pause on marginal projects if the money doesn't calculate out or if the risks seem too great. But the cost of capital still does work in the economy.
To what extent do you hope, if you did a rate cut, that it would basically weaken the dollar, help exporters, and boost inflation a little bit?
The dollar is the Treasury's responsibility, so when we're making our judgments about monetary policy, we're really thinking of the inflation mandate and the full employment mandate. And the dollar is one of the financial variables we track, but we don't think about it as an outcome of our policy, largely as an input of our policy.
It would likely go down, would it not?
It depends on a variety of other factors. It depends on, the dollar fluctuates for more than just the strength of the U.S. economy. It fluctuates on issues related to geopolitical issues, debt ceilings, et cetera. So, that theory would tell you that would happen, but that's not what you would think necessarily could happen.
If you do a rate cut on July 31st, how do you feel about the debate over whether it should be 50 basis points or 25 basis points, the new theory that it's better to take stronger action earlier? Well,
that's a theory that's actually not as new as it seems. It's just the first time we've had to think about it in a long time. But that's a theory that came out of the research after the Great Recession in the financial recovery, that using your tools early and maintaining yourself away from the zero lower bound is important. That will depend, in my judgment, for me, a lot on how the data come in. If the data come in that shows significant weakening, that would call for different actions than if the data come in and say that we're just getting headwinds and we're slowing. So it's too early from my perspective to know whether we should use the tool at all and what magnitude of the tool we should apply.